You're watching Fox 13's Good Day Tampa Bay.
Well, by now you may have heard the Federal Reserve has cut interest rates for the first time in more than a decade.
But some of you may be wondering what exactly that means for you and your daily life. After the break, we're going to sit down with a financial advisor to break it all down a little more in detail for you. For the first time in a decade this week, the Fed's cut the interest rate, and economists say this quarter-point cut, it's a signal from the central bank that it's hoping to get ahead of a potential downturn, a slump in the economy. But then we have the president announcing this 10% tariff on Chinese goods, so some analysts are worrying that could hit American consumers and businesses hard. We wanted to talk this weekend about how these big moves up at the top actually affect our daily lives. So we're joined this morning by financial advisor John Troncoso. There we go. I kind of just reversed that for you.
That's okay.
We wanted to talk about how we won't miss any key opportunities that come from these big maneuvers at the top. So first things first, when we talked about this at the beginning of the week, it was basically that we're talking barely dollar differences when it comes to our credit card debt or car loan. How are we going to feel it?
Sure. So I absolutely agree. I think it's largely symbolic in nature.
Okay.
This is the first cut since 2008, and when you look back at that time, the financial system was on the verge of collapse. You had Lehman Brothers, Bear Stearns, and the entire financial economy was in a terrible, terrible place. We're not there yet. I look at this as somewhat of preventive medicine. So the Fed is just signaling that they're willing to help in case things do go awry. The impact is going to vary. Like you said, for credit card consumers, it might be a couple dollars a month.
Okay.
But there are people that would benefit quite tremendously by this.
And who are those people? Who gets the best kind of change?
Of course. So anybody that's borrowing on a variable rate has already taken out the loan. So think student loans. Some of those are private debt that you can adjust the rates, credit card debt, adjustable rate mortgages. And I think specifically somebody who took out a loan last year, they were paying about 5% interest rates. Those have come down all the way to about 3.75%. So if you were to refinance under those ideal conditions, you can save a few $100s a month.
Speaking of refinancing, as somebody who, closed on a house late last year, and now I'm looking at these rates, they just kept going down and down and down for mortgages. Is this a good time to refinance, or should we hold out and wait a little bit more?
Well, I don't try to be a prognosticator of the markets or the Federal Reserve. They always say don't fight the Fed. But what I do think is that if refinancing is going to make a meaningful impact on your monthly expenses, that's generally a pretty good idea. I would say, though, that you probably should work with a financial service professional, a certified financial planner, because they're going to be able to look at all the variables in your life and decide what is the best option for you.
What's your advice to consumers out there when these things happen as far as capitalizing on it in your own either investment choices or how you're saving?
Well, I certainly think that the best times are behind us. We've had 121 months of an expansion. That's the longest in U.S. history. So in regards to portfolio management, I would certainly be buttoning down the hatches. And what I mean by that is conduct the what-if scenario. If the markets were to go down 25, 30%, what would that look like in my portfolio? So am I taking too much risk or too little risk? Additionally, I think retirees are in a very precarious position. These are people living on fixed income, so higher rates, higher income, and lower rates, lower income. And I think oftentimes they go down the path of saying, well, I can take a little bit more risk to help pay for some of these bills. But I think that that's doubling down just as the economy is starting to show some signs of financial stress.
No, that makes sense, especially with a lot of retirees in our area. Finally, one last quick question when we talk about something like the tariffs as well, another top-down thing where we say, how does this really affect me? Is there any advice you have for people as far as proactively taking some steps involving that?
Sure. So I think the tariffs, that was part of what the Federal Reserve was taking into consideration.
When they did this
exactly
drop
right.
Here,
It's this preventative medicine. My worry is that sometimes if you use up all the medicine before the patient's actually truly sick, then our response will be somewhat muted if a recession does come. So the average consumer can just really watch their expenses, making sure that they're taking advantage of things like refinancing, and really just paying close attention. The stock market is a great leading indicator of what's to come in the economy.
There you go. You won't prognosticate, but the stock market will. Hey, thank you so much. Nice to have you with us. Great thoughts.